Ok, grazie. Scusa, per andare su e giù questi oppure ok. E lo punto, dov'è che dove lo devo puntare? Dove va puntato questo? Ah, prende comunque. Ok, perfetto. Sì, ma io preferisco andare col dito. Ok, grazie così.
Okay, so good afternoon everyone, and welcome back. I hope you had a great holiday break. Now we are back to work, and it's a great pleasure to introduce to you Professor Marco Corazza, a colleague from the Department of Economics here at the Stochastic University. And we know each other since I think 20 years or so. And he does a lot of interesting work in the field of optimization, multi-criteria optimization. He likes using nature-inspired or human-inspired algorithms. And today he'll be talking about stochastic control approaches to financial trading. Thank you very much for coming.
Thank you very much. Good afternoon, everybody. I'm really glad to be here. I thank Marcello and the Center for this possibility. Well, today I speak about the possibility to build and, of course, to implement an effective system for financial trading based on a particular kind of machine learning known as reinforcement learning. In particular, I'll consider two algorithms belonging to the family of the reinforcement learning, the Q-learning algorithm and the SARSA algorithm. Well, here you have more or less a summary of this talk. There will be an introduction. In this introduction, I'll attempt to find some methodological base for the building of the trading systems. Okay. Then I spend some words about reinforcement learning in general as a philosophy of learning, and then I introduce in particular the two algorithms and the related stochastic control optimization problem that we solve for the trading system. Then, at the end, we'll see the details about the operational implementation of this trading system and an application to 5 assets, to 5 stocks of the Italian stock market. Well, first of all, a very simple definition. What is a trading system? This definition is not a technical definition. In fact, it comes from this website, which is the equivalent for professional investor of Wikipedia, Investopedia. So it is a practical and operative definition, and a trade system is a set of rules and, of course, related parameters by which it is possible to determine the signal of entry and exit point for a given equity. Entry is a signal in which I decide to buy or to sell this asset, and of course the exit point is the reversal point. So, in a very simple way, a trading system, a financial trading system, is a system that, by a set of rules, say me when I have to buy or to sell a given asset. Okay, so this definition is very simple. Well, before to enter in the technical details about reinforcement learning, Q-learning, their details about the implementation of the operational of the trading systems, we have to attempt to give an answer to this question. In other terms, is it possible to use machine learning method for developing, of course, profitable trading system? Because for developing a trading system which are not profitable, more or less, all of us is able to do this. Okay, well, we have two answers, a classical answer and a modern answer. Here, in this first part, attempt, as I said before, to give the methodological basis for the building of the trading system. Well, the classical answer is based on the classical theory about the financial market. That is the efficient market hypothesis. This theory is the theory by which in the 2013 Eugene Fama won the Nobel Prize in economics. So it is the most important theory about the running of financial markets. Okay, well, following this theory, in a liquid financial market, the prices are able to reflect in a perfect way and in an instantaneous way all the available information. Of course, this is possible by the iteration of the demand and the supply. There is a new information, like for instance the new Dieselgate of the FCA of this day. The demand and the supply move the price, and we have the new price. Following this theory, given that the market is efficient, that is, the market is able to move, to reflect the information in a correct and in an instantaneous way, there is not the possibility to make profitable trading system. Okay? You can see in these two graphs an exemplification of this idea. This is the current price of a given asset. In this instant time, there is a bad news. The market is efficient, so the market is able to reflect in an instantaneous way and in correct way. That is, this difference is exactly the difference, the decreasing of the price which corresponds to this bad news, and here we have the new price. Of course, here we have no time for applying a trade system, for exploiting this new information. Okay? This is what is said by the efficient market hypothesis. In other terms, using a little bit more formal representation, the best forecast for the price of tomorrow is the price of today. In other terms, in the basic version of the efficient market hypothesis, financial prices are random noise. Of course, if they are random noise, there is not a possibility to make forecast. If there is not a possibility to make forecast, it is not possible to build a profitable financial trading system. And as a first consequence, my talk should finish here. Bye bye. But okay, and this is not a good news. Well, but likely, in the final part of the past century, another scholar, Andrew Law of the Massachusetts Institute of Technology, has proposed a generalization of the efficient market hypothesis. In the efficient market hypothesis, all the investors are considered as perfectly rational in the sense that when I receive the news, bad news or good news, I'm able to react in a perfect way to this information. So I am rational as investor in this sense in the previous series. In the adaptive market hypothesis, this hypothesis of perfect rationality of the investor is relaxed. And in this theory, it is said that investors are not rational, but they are intelligent. In the sense that, in this approach, financial markets are seen, in some sense, like ecological system in which different species, investors, banks, mutual funds, and so on, interact among them, each in order to maximize their profit, by complex relationship. Of course, during this interaction among the various agents, each of these agents is able to learn, and after a certain period, I'm able to evaluate the real importance of a bad news or of a good news. For instance, given the same situation that we have seen for the previous theory, again in the case of bad news, this is again the current price. Here, in this instant time, we receive a bad news, but the agents, by learning, by the iteration among them, react to this bad news not in instantaneous way and not in a correct way, but for instance, or in this way, in which by learning after a given period, I reach the new price of the asset, or for instance, in this way, this is a typical case of overreaction to the information, in which in the first period, the new valuation of the asset is not right, but after a given period, I reach the optimal value. Of course, in this situation, if the trading system is intelligent, there is the possibility to exploit the information for making profitable trading. For instance, if my financial system were so intelligent to understand, sorry, to understand here that there will be this increase of the price, I can buy here the asset and to sell here the asset. So, inside this new methodological framework, the adaptive framework, there is the methodological possibility to build an effective and profitable trading systems.
You're making this distinction between intelligent and rational agents. What is the difference? What do you define an agent? Intelligent and then the other?
Well, the difference is that when we ask that an agent is rational, if an agent is rational, it is also intelligent, but in particular, it is infinite resource in the sense that it is able to process any quantity of information in a very short time. Okay, we, in some case, relax this hypothesis and assume that the agent is only intelligent, that its resources are limited, and so it needs some time for calculating the new price, okay? And in particular, we need that this agent is intelligent for making, in some sense, the correct.
Is there also a notion of full knowledge against partial knowledge?
Maybe.
An agent which has all available information against an agent which only has a subset.
Okay. This is a possible way by interpreting this. In any case, this difference between partial knowledge and all knowledge is yet considered in the efficient market hypothesis. In fact, there are various degrees of the efficient market hypothesis. There is the weak form, in which each investor has knowledge only about the prices and the volumes, okay? Which is any of us can do by looking, for instance, a financial provider, Yahoo Finance, for instance. In Yahoo Finance, we can find this information. Semi-strong form, if we have public information, that is past prices, volumes, and any other public information, for instance, taxation, inflation, and so on. And the strong form in which we consider both public but also private information. In this case, there can be the insider trading, because not everybody has the possibility to use the private. So, okay, well, so given that it is well known that human beings are not rational, but at all the same. Anyway, it is more reasonable to assume the adaptive market hypothesis than the efficient market hypothesis, and in particular, given this idea following which there is an intelligent iteration between the various agents, we need that our trading system is intelligent. This is the reason for which in this talk I present a trading system which is intelligent, because we need that this trading system is able to interact with the other agents of the market. Well, why reinforcement learning? We know that you are more expert than me about machine learning, artificial intelligence, and so on. But more or less, there are three main big family about learning methodology. In this talk, I use the reinforcement learning because given that the trading system has continues to learn, because in the market new information arrive continuously, we need a kind of machine learning which is always online. So, for instance, if we should consider the supervised learning, we know that, like for instance, artificial neural network, we know that there is a certain period, a first part in which we estimated the weight, and then with the frozen weight, we apply the neural network. This is not the case. We need an approach by which the weight are continuously change. Well, in short and in a graphical way, the philosophy underlying the reinforcement learning can be represented in this way. We have an agent that in our case will be the trading system. We have an environment that in our case will be the financial market. And at the beginning of the time in t equal to 0, the agent studies the environment by a set of states, Given these states, the agent interact an action. In our case, the action can be buy the asset, sell the asset, and so on. At the end of period, at the end of the period, the environment give this action provides a reward to the agent, in the sense that if my action has been good, I have a gain, for instance, from the investment. Otherwise, I have a loss. And on the basis of this reward, the trading system updates its internal parameters, that is, learns, and in period 1 restart all the mechanism. So from the point of view, from the qualitative point of view, the reinforcement learning is very simple to represent. Okay. Well, what we need for specifying the reinforcement learning approach is the following. First of all, we consider a discrete time of framework. In the application that I'll show you at the end of the presentation, we consider about 30 years of daily closing price. So in this case, these are days. Then a state vector. The specification of the state vector is particularly important because by the state vector, we describe to the trading system the financial markets. We need, of course, an asset of action that in our case will be buy or sell the asset. And finally, we have also a reward function, that is the function by which we have a measure of the performance of the trading system. In particular, this one is the reward function related to the current price, to the current time, okay? But in the reinforcement learning approach, we are interested in considering the reward of all the future. So the goal of the system consists in maximizing this global reward, which is given by the current reward plus the reward of the second period, properly discounted, okay? Because of course gain or losses in the future are less value than a current gain or losses. You can see that gamma is lower than 1, plus the the reward in the third period, again properly discounted, and so on. So we want that our system is able to maximize this quantity. In this phase, you can see that we are attempting to write the problem, putting in evidence its dynamic aspect, because at the end of this part we should have a stochastic control problem to solve. Okay, so we can see that the global reward at the time t depends on the particular reward of time t plus 1, time t plus 2, and so on. Well, then the goal of the reinforcement learning consists in detecting a policy, that is, in finding the sequence of action by cell, by, and so on, by which it is possible to maximize this quantity.
Okay, when you talk about s t plus 2, or everything is t plus 2, it is an expected prediction?
No. We'll see. This is the formalization before the expectation. In a perfect world, we would like that the system were able to maximize this quantity. Of course, the system is not able to maximize the quantity, and we'll see that the system has to maximize the expectation of this, okay? And then we'll see how to formalize this aspect, okay? Okay, so this is the function to maximize. Of course, we don't know the future value, so we need to reformulate the system goals. In fact, we need to maximize the expected value of this same quantity. In this part, I want to spend only a few words because it is a technical part from a mathematical point of view, in the sense that following in according with the optimal control theory, we need to define a value function, then we need to write the Bellman equation. So we have to improve some technical details. In any way, it is possible to reformulate this quantity both in this form and also in this one. Notice that the difference between this, the expectation of the global reward given the current state, and this one, again the expectation of the global reward given the current state and given the current action, the Q-learning and the SARSA method use this second one, okay? This is the standard formulation. This is a particular formulation in which the action is made explicit. Well. At this point, given that we don't know the value of this expectation, we use a classical recursive method, which is typical in the control theory, by which in any instant t we improve the estimation of the value function by a recursive method in which the k plus 1 iteration depends on the previous one. Okay, so given a proper stopping rule, in each instant time we consider this approximate iterative estimator. Okay, well, so at the end, in each instant time, by this approximate iterative procedure, we find the value of A, that is the optimal action by or cell, by which it is possible to maximize this quantity. Notice that in the two approaches that we'll implement in the last part of the talk. We generally use as a signal, as action, the one which maximizes this quantity. But in the epsilon percentage of the case, we consider an action generated at random. In this way, we give it to the system the possibility to perform exploration in the solution space. More or less like in the case of genetic algorithm, in which there is exploitation, and the maximization of this part is equivalent to the exploitation. And in this case, in which in a few percentage of the cases we randomly generate the action, give the system the possibility to perform the exploration in the other part of the space of the solution. Okay? So also in this approach we have the two parts, exploration and exploitation. Okay. Oh, well, the Q-learning and the SARSA learning are the two particular approaches that we use in this implementation. You can see that, similarly to what we have seen before, in we have that. Again, we apply the approximate iterative procedure, and the only, following according to the scheme that we have seen before, the only difference consists that the source use the first previous iteration, whereas the Q-learning, among all the possible previous iterations, use only the one for which this quantity is maximized.
SARSA stands for exactly?
State, action, reward, state, action. Very simple, very boring. Okay. They are two small versions of the same philosophy. Last boring technical point, of course, how to produce this estimation, because this is the recursive procedure. But in order to produce the first estimation, in literature it is suggested to consider some other approximator, and in this case we simply use this following linear functional. Of course, in a financial market, which is nonlinear, complex, and so on, to use a linear function, a linear functional, may appear not a good idea. But there are some theorems by which it is possible to prove that a linear functional ensures the fact that at least we reach a relative minimum, okay, in the error. Not an absolute, but we have some theorems by which it is possible to prove that if we use a linear functional, we are sure that if we consider the surface of the error, at least we found a local optimum. Okay, so in this quantity, in this linear functional, we have some parameters that we estimated by a usual gradient descent techniques. We use as input the states, also the action, and both the states and the action are used as input of this function, which is more or less a squashing function similar to the one using in the artificial neural network. So, under this point of view, there is some similarities between the two approaches. Okay, under this point of view, our approach is a stochastic optimal control problem, and it is adaptive This aspect is important because in general, in stochastic optimal control problem, it is necessary that the user provide to the system a description of the distributional properties of the system. In financial market, it is quite difficult. It is quite difficult to say a priori, well, the return of this asset is, for instance, normal or x square or t student and so on. Given that this system is adaptive, and given the fact that it is intelligent, we give to the system the duty to estimate the distributional properties, okay? In this sense, the fact to be adaptive is important for our approach. Well, after this first part, in which I've introduced a bit of technical detail, now we can begin to implement our system. For implementing our system, we have to specify the state vector, that is the variable way by which we describe the market, the action, the reward function, and also the transformation function, more other details. About the state vector, we describe the financial market by very simple variables, in the sense that this quantity, the logarithm of the current price over the past price, is known in financial literature as the logarithmic rate of return of an asset. It is a measure of the performance of an asset. More or less, it is possible to prove that it is very close to the percentage rate of return. Okay? So the state of the market, that is the way by which you describe the environment, is simply given by the current and the some past values of the rate of return of the asset that we are considering. For instance, the current return and the return of yesterday of an asset, and the last action. The idea to describe in this simple way the behavior is in some theory coherent with both the efficient market hypothesis and the adaptive one, because as you can see, we use only a very few number of rate of returns, because we expect that all the investor, all the species in the financial market are able to learn in a short time. They are not perfectly rationally. They are not able to learn in instantaneous way the importance of the new information, but in a short time, 3 periods, 4 periods, 5 periods, they are able to learn the importance of a new information. So in this case, we use or only the current return or the current and the previous 4. So I recall that the 5 daily returns is equivalent to a week of trade. Okay, so about the specification of the action. Well, the three actions that our trading system can interact are -1, that is sell the asset, +1, that is buy the asset, and further we have considered a third position. This third position generally is not considered in the most traded system proposed in the literature, but in our idea it is important that the trading system can consider also the possibility to stay out of the market, because, for instance, it is not able to evaluate in a correct way the information, it is not able to give a strong signal to buy or to sell. So we give to the market the possibility to stay out of the market. Okay, so we have 3 actions. Reward function. the reward function, I recall, is the function by which we provide the gain or the loss to the system, okay? In this case, we use this quantity, which is the Sharpe ratio. Sharpe ratio is likely one of the most known quantity in quantitative finance. Sharpe is another winner of Nobel Prize in economics, and the reward function simply is given by, before I present GT is the current gain obtained by the system, okay? ET is the return of the asset, multiply the previous action. If, for instance, ET is positive and the previous action said me buy that asset that is +1, of course, this is the correct action, and so here we have a gain. But if this quantity is positive, but previously my system said to me sell -1 with an increase in prices, of course, is a loss. Okay? So, GT is the current gain of my system. You can see that in this ratio, here I have the mean gain, the average gain in the previous L period, and this quantity is the volatility of the same quantity. In finance, volatility, standard deviation, this is the standard deviation that in finance is known as volatility, okay? Volatility is a measure of risk. And generally, the expected return is considered a measure of performance. So the reward function we use is given by this ratio in which we have a measure of performance over a measure of risk. In some sense, this is a measure of the performance per unit of risk, okay? Of course, we want that our system is able to maximize this quantity, okay? Given that this quantity are calculated over the last L performance, we have considered as L5, that is a week of trade, or 25, that is a month of week, because in a month there are more or less 21, 22 trading days. Okay, if you exclude the Sundays, Saturdays, and so on, these are the days of trading in a month. Further, we have considered also the transaction cost, and in several trading systems, this aspect is not considered. Okay. Finally, I recall you that when we consider this linear functional, we have to specify the squashing function, and usually, as often done for the artificial neural networks, we use this logistic expression that give us, in some sense, the possibility to cluster the negative returns and the positive returns. Well, again, it should be clear that both Q-learning and the SARSA are stochastic algorithm, because there is the random initialization of the weights of the system, because we use the exploration. So we need to iterate several times the trading. As number of iteration, we have decided to use 500, and for instance, in these figures, you can see the different 500 equity line produced by our system. Notice that 5,000 euros is the starting capital, and you can see that, of course, there is a certain number of trades whose final performance is lower than the starting capital, and this is of course not a good thing, but the most of the trades perform better. Well, finally, of course, if we consider 500 iterations, for each instant time, we have 500 actions. Buy, sell, stay out, buy, sell, and so on. What is the action that I have to apply to my system? In some sense, I have to aggregate all these states. Well, in literature, there is this proposal that, in my opinion, it is not a good proposal, but in this talk, I'll use it. Simply, we calculate the mean of all the action. If the value falls in this interval, then the action to apply is -1. If it falls in this one, -1/3 and 1/3 is 0, otherwise is 1. There are other possibilities. We are studying about the we are studying about the possibility to consider this one like a random variables, and so to build a confidence interval to evaluate if this mean is different or equal to 0, which is a little bit more founded than this, but in this case we use this. And finally, the application. We consider more than 7,500 data from, as you can see, almost 30 years of daily data, and we consider this asset as Assicurazioni Generali, Fiat, Pirelli, Simon, and blah blah blah. All assets coming from the Italian stock market. Notice that, given that we consider two algorithms of reinforcement learning, Q-learning and the SARSA, two values of n is the number of states, 1 and 5. Two values of L is the number of data on which is calculated the reward function, 5 and 22, and the three values of epsilon is the percentage for the exploration. We consider 24 different configurations. In this first figure, you can have an idea of the general behavior of the trading system. In this case, we are considering Telecom Italia. This is the performance of the Q-learning, in which we consider 5 states, that is the current performance and the 4 past performance, in which we calculated the reward on 22 data, and in which epsilon is equal to 10%. In this first panel, you can see the behavior of the price of the stock that we are considering. In this second panel, you can see the action produced by the system. For instance, in this case, the action is equal to +1. So in this case, the trading system is saying buy. Here, we have a case in which the action is equal to 0. That is, the trading system is saying stay out from the market. In other terms, our trading system is not sure about indication +1 or -1, and this, for instance, is a case in which the signal is -1, sell.
I'm not an expert in economics and never played with stock, etc. But we have to buy when the price is high.
You are right in the sense that I don't know if this is the best way to make science, but you can see that more or less after this period, the trading system in some sense learns and understands that there is an increase of the price. Anyway, general, all the trading system produce the signal with the late. Okay. Because of course, before I learn the beginning of the increasing or of the decreasing, and then I produce the right signal. Okay. Well, in this third panel, you can see the behavior of the equity line, that is the behavior of the gain or loss produced by the system. First, well, the blue line is the line in which we don't consider the transaction cost. The green line is the line in which we also consider the transaction cost. Because, of course, anyway, there is a change of position, we have to pay a cost. You can see that, given this starting capital, more or less, the equity line is more or less strictly increasing. Under this point of view, the trading system applied to this particular stock asset appears to be more or less performing. If we consider the same situation, but we change the Q-learning with the SARSA, you can see, for instance, that the SARSA shows a more nervous behavior. There is this very strong increasing in the equity line, but in this period, the SARSA is uncertain. 0, 1, 0, 1, 0, 1, ta, 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 ta. There are a large amount of transaction cost to pay, and in this period there is the decreasing. Here we have other period in which there is a peak in the performance, a decreasing, a peak. But notice that when the SARSA reaches this position, in some things it seems that it is able to understand that it is in a bad situation, that it is not able to learn the market, and so it prefers to stay out for all the remaining time. So, is a confession. I don't know if confession is right in English, but it is a confession. I'm not able to understand, to learn this market, so I prefer to do anything instead to lose a game. Okay? Of course, from the investor is not a good result, but from the machine learning point of view, the system is able to understand that it is not able to maximize the function that we want. Here you can see the performance for another of the asset, Pirelli. In this graph, I put together both the Q-learning performance, the blue line, and the SARSA performance, the red line. Notice that this black line is the starting capital, You can see that more or less the Q-learning is higher than the starting capital, whereas this is not true for the SARSA. This is a general behavior for the two approaches. That is, in general, Q-learning appears a little bit better than SARSA in implementing the system. But I would like to show you a global view about the result instead of to see asset per asset. So in order to evaluate globally evaluate the performance of the system, we use this simple estimator, this simple indicator. First of all, we consider the net average return per year. Okay? For instance, you can see that in the case of Assicurazioni Generali, here we have all the 24 configurations, Q-learning, SARSA, the values of L of epsilon. You can see that, for instance, Assicurazioni Generali is likely the best case, that in general, in each of the 30 years of the trading, for each of the 30 years, the net return per year is positive, okay? Only in a few cases it is negative, and it is very small. So in this case, whatever the configuration for each of the 30 years, the trading system, both the Q-learning, both the SARSA, with the 1 state, with the 5 states, and so on, have provided positive rate of return per year. Then, by this quantity, we measure the percentage of time for which the gain produced by the system is greater than the starting capital, because although the gain is not high, that at least the starting capital come back at the end of the period. And you can see that in more than 30 years, generally, the percentage of time in which the gain produced by the system is higher than the starting capital is always, with some case, is always very close to 90%, 100%, 98%, and so on. So,
how can you explain that behavior? Why 54.04? I mean, all the other ones are.
In this case,
54.04 in the second column over there.
In second column?
Yeah, exactly that one. I mean, all the other ones are 99.
My personal idea, given that in general, the performance per year is always lower than the previous one, likely the percentage used for the exploration is too much high, okay? We use too much exploration in this case, because if you look at also in this case, in which epsilon is equal to 10%, the performance are worse than in the previous case. Okay. This is, another question. This is the average number of trades per year. You can see that the trading performed in each year is very low, 5, 5, 7. So our system is a tranquil system, and this aspect is important because to each trade is associated the cost. So if I perform a few number of trades, I have to pay few costs, okay? So this is a good aspect. In this case, you can see the worst case, which is associated to Pirelli. This is the worst case in the sense that we have a certain number of cases in which the performance is negative, but we have also a certain number of cases in which the performance is again positive. So it is worse comparatively with the other one, which are particularly good. And finally, considering all the configuration for all the assets, we can see that in general, I comment only this first result. Given all the assets and given all the 24 configuration, in the 70% of the cases for the Q-learning and in the 71% of the cases for the SARSA, the average net rate of return is positive. So it seems that both SARSA and Q-learning are able to perform the financial trade in a good way. Only again, one slide for you. Well, Q-learning and SARSA achieve both satisfactory result, and so the fact that we use simple state, only the returns, and not refine the configuration because, for instance, we have not performed a particular study about the estimation of the learning coefficient and so on. Currently, we are working about the specification of states which are more refined than the log returns. The same for the reward function. The Sharpe ratio is, in some sense, a milestone in finance, and here we have used the Sharpe ratio as a reward function. But for instance, as you have seen, Sharpe ratio uses only mean and variance. But in general, the return distribution finance are also skewed. There is kurtosis, so also the other moment could be interesting. And finally, for the estimation of the value function, we have considered the linear functional. Also in this case, we have said that the linear functional is too simple for complex financial market. In literature, there are some proposals to substitute this linear functional by more complex model, like for instance, artificial neural networks. The point is that if we use artificial neural network, we gain from the nonlinear point of view, but we lose that theorem, those theorems that ensure the reaching of a relative minimum. Okay, so there is a trade-off between the use of a linear functional and so on. Well, that's all. Thanks for your attention. And here there is a very mini list of reference 3 papers. The one of Law about the adaptive market hypothesis. This of Moody's, which is likely one of the first papers in which the reinforcement learning is used for making financial trading, and this one, which is a paper written by myself and Bertoluzzo about the application of the system similar to this one. Thanks again for your attention.
Break the ice. There is a very nice connection between reinforcement learning on the one hand and evolutionary game theory. Both actually the very way in which you describe the financial market as a collection of species, interactions somehow. Is there any attempt in the literature trying to exploit evolutionary game theory and then the dynamics behind that in order to solve?
Well, in literature there are some applications about the evolutionary game theory, but from a descriptive point of view, in the sense to describe how financial market or not financial market can evolve. But to the best of my knowledge, there are not applications to operative tools like, for instance, trading system and so on. So they are more used for the description of the main stylized facts characterize the market.
Okay, so this is a nice connection. One more thing is the following. Machine learning, there are lots of benchmark data sets. So if you invent your own algorithm for solving a problem,
right.
Is there something like this in this field, so that you can provide kind of a quantitative way of success?
Okay, well, of course, currently we are testing this system in other markets on other time series. Of course, generally, for each time series, you can find a specific paper in which there is the ad hoc algorithm. Well, this is the reason, one of the reasons for which we have decided to use simple states. We have decided to use also for the reward function a standard reward function, because we don't want to attempt to hyper specialize the algorithm to this time series, and if applied to other time series we have not the same result. But we are not sure that this is a good way, of course. Now we are testing this approach on the USA market, The problem is, of course, that given that we have to repeat at least 500 times for each time series, the computational times is very large, and also we have our scientific systems, the CS, okay, but the time we need for this application, no, but for the testing that we are performing in this period we are using the system, anyway, we need a lot amount of time.
That's the reason why our applications run so slow.
No. This is surely this is not the reason.
So you're able to predict if the action in a proper way, not in a proper way, but in a short amount of time, such as that you can.
Well, yeah. Okay, well, of course, in the application, I have 7,500 data, but in a real application, I have to deal with one data at a time. Okay, so in that case, the system can be used also from an operative point of view. A previous version of this model is running in the provider of a firm with the provider financial services. Some interested investor have seen the model and we are waiting for an answer, but generally when the investor, the professional investor, is not able to understand the models, it is a bad model by definition. It is too much complicated, it is a bad model, point. And this is difficult between research and industry, there is the problem.
I was also wondering whether you can generalize this model to multiple time series.
No, we have not again attempted this because again per computational times.
But
in principle it's possible, but the stochastic control problem, yeah. Because of course it could give the possibility to explore both the usual correlation but also nonlinear relationship, but the stochastic control problem in this case is very difficult, and also from the computational time I fear that we have some problem.
Just a question. I understand that the main hypothesis always is random walk.
This is, yeah.
I wonder if, there is no idea to analyze a more delay structure. That is a thing. Looking at the time series, you can see that there is a kind of pattern that is not just random walk that's depending just on one time, previous time. But there is no memory, let's say, in the time series, in the financial time series, or why?
Well, the fact that the evolution of a financial price can be described by a random walk is predicted by the efficient market hypothesis, which is the classical one. When we assume the adaptive market hypothesis, this conclusion is not more true, but anywhere we have verified that if we consider too much lagged period, in this case we introduce more noise than information. We have verified that in general, if we use only the returns, the current returns and 2-3 past returns are the higher number, providing again more information than noise. Okay. This is the reason for which we at most use 5 states: the current return, the past of 2 periods, and so on.
Maximum 4.
Currently, the current one and the maximum
4.
Past one.
And
4.
The time is usually what? Day, hour,
well,
minute?
In this application, we have a daily application, but we have tested only on data provided each 50 minutes. Okay?
50 minutes.
But in this case, the time of elaboration, it is not always compatible with the operativity, because if we have a signal every 50 minutes and we need 3-4 minutes for the calculation, generally then the provider of the data give us the data 1 or 2 minutes after the quarter. So we lose 2 minutes. Then we need 4 or 5 minutes for the process. We are able to provide the action 3-4 minutes before the next quarter. So at least if in this case it is absolutely necessary to have a system which is dedicated to this computation.
But it's quite a long question, so maybe I can ask you. Okay. No, because it's in a completely different domain, so that's why. Okay, a friend of mine was working with time series to predict action from the brain.
Okay.
To read more or less the same thing.
Yeah.
And it's connected to the question of Professor Pellil about having multiple signals from, so it is able to analyze multiple time series at the same time. In this case, we have something like 1,000 time series.
In principle, it is absolutely possible. Of course, as I said before, there is the problem that in general, the...
Well, in our case, the action are not by cell or state, but it go left or right.
Anyway, a discrete asset of action. The problem is that in this case, at least in this kind of application, of course, the stochastic control problem become more and more difficult than this, and then from an operational point of view, we need a large amount of computational time. These are the main difficulties, but in principle there is not difficult to implement more time series, the various relationship and so on.
And I guess you can also use continuous action, right?
Well, the idea of a continuous, okay, this is a trading systems. The idea of a continuous action is more close to the portfolio selection, in which I have to decide the percentage to capital to invest in the first and the second asset, but also in this case, also in principle, there is not problem also in this case.
More questions? How to make money?
No, but yeah, you talked about the efficient market hypothesis and adaptive market hypothesis, and what do you think about the fractal market hypothesis?
Well, okay. Well, the fractal market hypothesis, on which I wrote some paper about 22 years ago, is a first attempt to generalize the efficient market hypothesis, in the sense that, likely as you know, in the efficient market hypothesis, the normal distribution is assumed. But it is possible to prove that the normal distribution is the distribution characterizing the returns. In the fractal market hypothesis, given the fact that there is a long-term memory, you can again use the normal distribution, but we have to use the fractal Brownian motion, in which the variance depend on h, the Hart exponent. Okay, do you know this aspect or not? Okay, in which there is h. And in this case, simply, you are able to introduce a memory of the past. But there is not a methodological explanation about which are the reasons for which there is this memory. In the adaptive market hypothesis, there is also a methodological framework, an evolutionary view of the market. Sincerely, I don't know, but given your question, it is possible that also the fractional market hypothesis can be a particular case of the adaptive, because if there is memory, it means that in some sense the agents characterize the market maintains the memory of the past. So again, we have agents, we have memory, and well, I don't know, but it could be an interesting point to investigate.
Okay, so let's thank Marco again. Thank you very much.
Thank you for your attention. Thanks.